You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. Pandemic inflation proved to be more persistent and intense than many expected, especially at the Fed. Inflation models that incorrectly predicted 2021 price increases to be transitory also suggested that disinflation this year could only occur with significant labor market softening. With the last mile of the Fed's inflation fight just around the corner, these models are getting a closer look so that central banks and market participants can have a better grasp of what drives inflation in the future. On today's episode, we talk with Peter Hooper, Managing Director and Vice Chair of Research at Deutsche Bank, about inflation modeling at the Fed and what the models got right and wrong throughout the pandemic. Stay tuned. Coming up soon, our interview with Peter Hooper, Managing Director and Vice Chair of Research at Deutsche Bank. But first, a quick market update. The FOMC left rates unchanged this week, as expected. Chair Powell's press conference gave very little forward guidance, leaving open the possibility of an additional Fed hike this cycle, but not particularly confident in how much or when higher long-term bond yields will slow the economy. The bond market is focusing on much more than just the possibility of another Fed rate hike, however. This week, Treasury announced its borrowing needs for the next 3 months, estimating an increase in auction sizes for long-term securities that was slightly lower than most analysts expected. 10s and 30s rallied 15 basis points after Wednesday morning's refunding announcement, and as of Friday morning are yielding nearly 45 basis points lower than the respective cycle highs we saw less than 2 weeks ago. The long end of the yield curve is much closer to where we estimate fair value to be right now. Twos continue to be anchored around 5%. Third quarter GDP grew at a red-hot 4.9% annualized rate, well above the Fed's estimate for long-run potential. The September PCE report confirmed CPI data that suggested inflation pressures slightly accelerated to end the third quarter. This week, the October employment report showed slowing job growth and a slight uptick in the unemployment rate to 3.9%. There's a lingering mystery about why the hard economic data is showing a resilient economy, while surveys and anecdotes, like this week's ISM surveys, are painting a picture of much more tepid growth. The Fed will decide policy in the hard data, but they'll be keeping an eye on the surveys as well. Since beginning almost 4 weeks ago, the war in Israel has slowly escalated but has so far not become a wider regional conflict. The House of Representatives elected Mike Johnson as its speaker after 22 days without formal leadership. Aid to Israel and Ukraine are immediately on the agenda, but so is passing a continuing resolution before the government runs out of funding November 18th. That's all for the market update this time. Now, our interview with Peter Hooper. Our guest today is Peter Hooper, Managing Director and Vice Chair of Research at Deutsche Bank. Peter, thanks for coming on the podcast.
Well, glad to be on with you.
Our topic today is inflation, how to understand its dynamics, but also how the Fed models it. Peter, to give our listeners a better sense of your perspective, can you walk us through your experience and familiarity with inflation modeling, particularly at the Fed?
I've spent many years at the Fed in the modeling more on the international side. Got to be very familiar with the way folks forecasted inflation and how they use the models. The workhorse model that the Fed uses is a variant of the Phillips curve, which relates inflation to its recent past performance, to expected inflation, to the rate of unemployment, how much unemployment differs from full employment, to various other factors, including import prices and some effort to capture some supply shocks and restraints on the economy. The model has performed reasonably well over the last several decades. Prior to the pandemic, it performed reasonably well in capturing low and stable inflation, a period during which inflation expectations were pretty well anchored around 2%, and they played a dominant role in driving actual inflation. Variance in unemployment over time has been somewhat less. During that stable inflation period was lower and less important factor. That's the workhorse model, and the relative importance of expectations versus unemployment has changed over time. as I think we'll get into, it changed fairly significantly post-pandemic period.
I think it's really obviously important to talk about how these models, how our understanding of inflation has kind of performed during the weird disruptions of the pandemic economy. But just to get into a few of those bullet points a little bit more. So, can you talk about how inflation expectations or the unemployment rate are things that connect to projections for future inflation?
When firms, businesses set prices for their products, it's driven by, to some important extent, by what they expect prices to be doing going forward. If you set your prices too high, you're going to be cutting the amount you sell. If you set them too low, you may forego profit opportunities. So, how people see inflation going forward is an important driver of what's actually happening to prices and the rate at which they change. The pressure on price, of course, is also driven by supply and demand factors in the overall economy. And these are summarized by what's happening to the rate of unemployment. When unemployment is rising, it's usually because demand is growing more slowly in the economy, less output that puts sort of downward pressure on prices. When unemployment's falling, it's usually because the economy is growing more rapidly. Demand is growing. There may be some supply factors there as well, but in a period of strong demand, as represented by a labor market that's going to be relatively tight, falling unemployment, that tends to raise pressure on prices. I'll say that over the long, stable inflation period we had prior to the pandemic, movements in unemployment were less important than just the well-anchored inflation expectations. And with that helped to keep inflation running pretty close to 2% for quite a while. That, of course, changed when we had a huge supply disruption during the pandemic, when we had huge swings in demand resulting from the pandemic and the considerable fiscal support that came on stream to support demand during that period.
So the pandemic economy has been unusual in countless ways, and I think every crisis, every cycle, our understanding of how the economy works gets tested. So I want to dig more a little bit into how you think the Fed's inflation models have held up in terms of understanding and predicting inflation this cycle. So to go back to those two things, inflation expectations and the unemployment rate or the labor market. Now, I think the intuition behind how inflation expectations can lead to future inflation makes sense to me in the sense that if households and businesses expect price increases to be a certain amount, they're going to negotiate contracts in a way that kind of compensates them for that, and it becomes a self-fulfilling prophecy. But as far as we can tell, survey-based and market-based inflation expectations have been pretty steady over the last couple years, but we've seen inflation go up. It's been quite volatile over the last couple years. Do you think inflation expectations play as big of a part in future inflation as Fed models have kind of factored in the last few decades?
Well, they played a very important role during the period of low and stable inflation leading up to the pandemic. When the pandemic hit, the models did not do a very good job of catching the sudden surge in inflation that we had. And that was due to a combination of pretty abrupt supply shocks, disruptions to supply chains globally, goods not being available in the quantity that was wanted during the pandemic. People shifted back their spending on services and increased their spending on goods pretty substantially at a time when goods production was disrupted. So prices went up dramatically, especially in sectors like cars, auto, used car, and the new car prices went up substantially. And in some services as well, airfares, because of supply constraints as well as demand, went up substantially. But during that period, you did begin to see a noticeable pickup in inflation expectations by early 2022. A variety of measures, especially the inflation forecasters, the Philly Fed surveys of professional forecasters, and Their expectations for a long time had been flat at 2%, but they began to rise noticeably up into the mid twos toward 3%, which was a real warning sign that inflation expectations could become unanchored. And that's the point at which the Fed, which had been talking about the inflation shock to that point being transitory, suddenly realized that it was behind the curve. It knew it needed to start raising rates pretty dramatically to get back on top of things. And as it tightened monetary policy substantially, inflation expectations came back down. So we were at risk of an unanchoring of inflation expectations, which would have given us a much more sustained high level of inflation. And in fact, in the wake of the Fed's action, in the wake of inflation expectations coming back down, you have seen some significant progress in getting inflation back down to toward more normal levels. We're not all the way there yet. We have made some progress.
I want to talk then about the relationship between the unemployment rate and inflation. Kind of get a sense of whether you think our perspective on the relationship between the labor market and inflation has changed, or if there's just kind of some noise that helps put it into perspective. Because I think when a lot of people look at the relationship over the last couple of years, there seems to be what is called immaculate disinflation, and that is in the last 18 months or so, when the Fed has engaged in this rapid monetary tightening, the unemployment rate more or less hasn't budged, but we've seen price pressures really come down in year-over-year terms, in monthly momentum. So it seems like the labor market has been able to stay quite healthy. The unemployment rate has been under 4% now for a year and a half, and we haven't had to kind of sacrifice a lot of jobs to get inflation to come down. So how do you put that relationship into perspective right now?
The unemployment rate is a factor, but I think it's what our models are telling us. It's a less important factor than it may have been in the past, and inflation expectations have become perhaps a more important factor. Now, I think the decline in inflation that we've seen, I can attribute in part to the progress that has been made on the supply side of the economy. You've seen a substantial decline in supply chain disruptions. International transportation of goods has returned back toward more normal behavior. That sort of price pressure on goods prices has receded. At the same time, you still have a labor market that is on the tight side. You have wage inflation that is higher than the level that it needs to go to get the inflation rate sustainably back to the Fed's objective of a 2% target. And we are likely going to need to see some, at least moderate increase in unemployment to get the job done all the way. We've had some favorable supply side developments that have helped bring inflation down. We've had inflation expectations based on the Fed's aggressive tightening of policy. And the piece that's missing right now, the piece that's going to get us, we think, all the way back to the desired level of 2% is we will need to begin to see some softening in the labor market ahead. We think that's still coming. Effects of the impressive monetary tightening that we've seen usually takes place with a lag of a year or two. And we're just now beginning to enter the period, but we do have further to go to get the job done.
I want to get a little bit more into inflation at the Fed. So the first question comes to what you just kind of talked about with the labor market and a lot of the noisier aspects of inflation. So whether it's supply chains normalizing, it could be food and energy prices related to Russia's invasion of Ukraine. So the way that the Fed seems to be gauging underlying inflation right now, when all of that noise zeroes out, is this idea of the supercore, which is services prices excluding shelter and energy services. Do you think that as we go into this next stage of the inflation fight, the so-called last mile to get it down to 2%, that the supercore is a pretty accurate gauge of what we should be looking at when it comes to the Fed's progress in getting inflation down to 2%?
I think that's fair, in part because that is an area that is probably as sensitive as any to the state of the labor market. We need to be some softening in the labor market to get wage inflation down, to get that super core measure of inflation down. As an example, one of the key elements in that super core is healthcare inflation, and that's an area where prices have lagged behind the significant increases in wages. So there's likely to be still some catch up there, which drives home the point that we're not going to see the job fully done until labor market is softened. And I think the behavior of that supercore is going to be a key indicator that the job is getting done. Of course, it's always possible that you can see some surprises elsewhere in the inflation picture. And obviously, oil prices have been picking up again recently, and that could have some transitory upward impacts on overall inflation.
The next thing connecting inflation and the Fed that I want to ask about is how the Fed or participants on the FOMC come up with their projections. So, in the minutes from an FOMC meeting this year, we learned that some staff projections differed a bit from what the members of the FOMC were projecting. There are tons of researchers and economists at the Fed. How does the research process end up influencing participants when the research might conclude different things? Or the FOMC participants themselves have an opinion that differs from what their staff says?
Well, in an earlier part of my career, I did spend several decades working at the Fed, on the Fed staff. It is an impressive body. There are several hundred PhD economists covering all aspects of the economy. The staff is organized with a top leadership that advises the board members directly, and various experts on various sectors will brief the board on their particular sectors. The staff comes up with its own forecast, both a bottom-up forecast from the experts in each of the sectors, contributing their inputs on what they see as happening in the labor market, in the energy sector, in various service sectors, where they see prices going. There's also a top-down view provided by some macro models that the Fed staff maintains. All these inputs go into a regular forecasting meeting that the staff holds before each FOMC meeting, and the staff projections are presented in a series of, they used to be green and blue books. They're now aqua books, I guess, that go to all of the FOMC members. I'll say that the various bank presidents have their own staffs and their own inputs. So each of the board members and bank presidents that participate in the FOMC have access to the board staff forecasts as well as their own bank staff forecasts, and they form their views, their own personal views. And this is what goes into the summary of economic projections, the so-called SAP, each forecast round. The staff at the board does play a central role in forming all of the FOMC members, but they each take that as one of a number of inputs into their own views that go into the SAP.
I want to take a step back and just look at inflation modeling kind of big picture. So, as far as I understand, most academic inflation models, they're based off this sense that the economy works like a complex machine. It's a combination of a lot of mathematical equations, somewhat resembling the physical world. But do you think economies, especially inflation, can be simplified in the ways that these models suggest? Or is there too much randomness involved, maybe just from human psychology? Essentially, how well do you think economists understand inflation?
I'll say that in terms of the various parts of the economy, inflation has been one of the more difficult to get right. In looking at the models and studying the models over time, they have performed reasonably well for some periods of time, and then you get new shocks, different development. I mean, for example, during the pandemic, the surge in inflation for a period of time was viewed as transitory, in part because we'd had a long history of very low and stable inflation, and people felt pretty strongly that we would return to that behavior fairly quickly. There were, at the time, large shocks, shocks we had not seen on the supply side in the memory of over the last 3 or 4 decades, as well as massive injection of fiscal stimulus to the economy that some models were saying would have inflationary impacts, but people look at a variety of different models. I think the answers were there, but there were a range of views and a range of different models that people were looking at. So the consensus was slow to adjust to the new reality of elevated inflation that we were facing. And I'd say overall, the profession gets a grade of an average C grade, not an A or B grade for for the speed with which it recognized the inflation problem at hand. We learn from our mistakes, and I think we have certainly, at this point, the Fed learned. It recognized before too long that it needed to act aggressively, and has done the right thing. And I think we're on the right track at this point. And I think we have a reasonably good. There is pretty strong agreement at this point that we will get inflation back to desired levels. No question that there's got to be a good deal of humility about our ability to forecast in the face of what was largely an unprecedented event.
I think when you look at what a lot of commentators, a lot of people, even within the FOMC, are saying about the trajectory of inflation. So whether you need to see an uptick in the unemployment rate to get inflation down to 2%, whether it's more supply driven or demand driven, there is a wide range of views on what the next kind of stage of inflation fighting looks like, how to get that last mile. Do you feel that economists and commentators are overlooking anything in particular when it comes to our current inflation analysis? Is there anything that you think is underappreciated?
We obviously made some mistakes during the pandemic. We used the word transitory too long, and we did not appreciate quickly enough the need to act more aggressively in the face of huge run-up that occurred. At this point, I think, as I listen to the broad commentary, I think maybe the central importance of this anchoring of inflation expectations may not be appreciated as fully as it needs to be. I mean, the remarkable unison of Fed voices about their adherence to their 2% of inflation objective. I mean, there have been many proposals. Well, why doesn't the Fed allow inflation to go a little higher? What's wrong with 3%, or what's wrong with raising the target to avoid the pain of slowing things down to get back down to 2%? I think the Fed recognizes the ultimate importance of this anchoring of inflation expectations. If they adjusted their target at this point, adjusted the goalposts, if you will, that could allow inflation expectations to rise and get us back into a more elevated inflation period. And there are all kinds of reasons why elevated inflation is not where we want to be. I think, well, some commentators and certainly the Fed appreciate the importance of this, a more across-the-board recognition of the very important role that the anchoring of inflation expectations has played in also allowing us to get back to where we want to be with a much softer landing than you've seen in the past. I mean, historically, whenever you've had this kind of disinflation, this kind of reduction in inflation, it's necessitated a much more painful adjustment in the labor market. You've had much bigger increases in unemployment in past disinflation periods. This time we're going to be able to get by with a relatively mild one, maybe a very mild recession, maybe a softish landing. But that's thanks, I think, to the increase in Fed credibility over time. Fed being far more credible today than it was during high inflation periods in the more distant past.
I think you've given me and our listeners a lot to think about. I want to end with just one Quick question, as we record this in the first week of October, given where the data is right now, what you see in the environment, what do you think the probability is that the U.S. economy is able to achieve a soft landing?
The odds on that outcome have certainly been rising. We were one of the first on the street to say that we would need to have a noticeable slowdown, at least a mild recession, but that given the lags in monetary policy, it probably wouldn't occur until late this year or early next year. I think at this point it's pretty close to even odds whether we get a mild recession or a so-called growth recession, a softish landing where growth slows below trend but doesn't get labeled ultimately as a recession. So we're still in the low 50s on the recession side, but it's a close one.
Peter Hooper, thank you for coming on the podcast.
My pleasure. Thank you.
That was Peter Hooper, Managing Director and Vice Chair of Research at Deutsche Bank. Inflation expectations can often feel like something not worth worrying about until they speed up, at which point it's even harder to get them anchored again close to the Fed's 2% target. I think Peter makes a good point for why anchored expectations are not something to take for granted as the Fed tries to bring inflation down to 2%. Fed officials are now open to speak publicly on monetary policy and the economy. We don't expect much commitment from officials on future policy decisions, but it'll be important to watch how they view the path of long-term bond yields heading into the December 13th FOMC decision. The data calendar next week is pretty light, with the preliminary University of Michigan survey for November on Friday, the biggest potential market mover. The following week, we'll see October data for CPI, PPI, and retail sales. Also next week, we'll see the first refunding auctions this quarter for the 3-year Treasury note, the 10-year note, and the 30-year bond. The auction sizes are slightly bigger than the previous 3 months, and the auction results will give early clues as to how easily markets are able to digest the higher issuance. October Treasury auctions were broadly weak. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions, comments, or concerns. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.